Should I be doing anything differently with my strategy for withdrawing from my beneficiary IRA? Um, would the proposed rules cause me to have any kind of penalties for missing these withdrawals in the past?
Yeah, this is a question that actually comes up within our client strategy sessions, uh, and it's a really, really amazingly complicated required minimum distributions. We call them RMDs. I've been around for a long time. They've always been complicated. There's been many different changes to them also, and so let's try to discuss what the question is. Number one, somebody inherits an IRA, right? So they call that a beneficiary IRA. There are a lot of different things that can happen depending on who you are and who the person was that gave it to you.
Mm-hmm.
So if you're a spouse, and so your spouse passes away and that spouse has an IRA, you can make that your IRA,
Yep.
right? So that's fairly straightforward. And that we get a lot of those. Those are pretty simple. And then it's just yours. And you handle that like you normally would. When you get to be 72, you have to start taking money out. And, that's a normal process. But a beneficiary IRA is established if it's not a spouse. So it's a separate account is kind of set up. Money goes in there. So it could be from your parents, could be from a sibling, a friend, whoever it is. And then there is criteria for how you take the money out. And it gets super crazy. So first of all, I'll call it a normal, if there is such a thing, a normal beneficiary IRA is one where you have to distribute the money over a 10-year period.
Mm-hmm.
So this is somewhat new. It's only been around for 3 or 4 years
Yeah,
now.
the Secure Act is.
Secure Act, yeah. So 2020.
Yep.
Yeah.
2020 was when it
Yeah.
started.
So they snuck this in there. They moved the. I think it's bad. They moved the minimum distribution age back from 70 and a half, which to 72, which sounds great, except they made it so that the beneficiaries, a normal beneficiary, has to take the money out over a 10-year period. Before they could stretch that, what we used to call a stretch IRA, we could stretch that out for the lifetime of the beneficiary. And so those were really awesome. They had to take out a little bit each year and no real big problems as far as that goes. So now, if you have to take all the money out in 10 years, there's a couple of issues that I see. Number one is just the size. The size of the IRA that you inherit matters. If you inherited a $20,000 IRA and you have to take it out over 10 years, the strategies aren't that critical. It's not enough money to really push you into higher tax brackets or those types of things. If you inherited a $2 million IRA, that's a totally different deal because now you're talking about a lot of money and basically generically what I would do without knowing anything else is basically just take out, I call it a 10-year required minimum distribution. Divide by 10 the first year, take that out. Divide by 9, use the ending year value. Next year, divide by 9, take that out. Divide by 8, 7, 6, 5, 4. And so if I didn't know anything else, that's one of the strategies I would use just because what I don't want to have happen is all of that money, a $2 million IRA that's now turned into $3 million over 10 years because that 7% money doubles every 10 years, right?
Yep.
So that's right, double. So it'd be $4 million. That's a huge amount of money to have come out at the end, right? So, but there are there are all kinds of other issues there. Maybe you're about to retire. We were talking about this earlier. So 2 years from now, you're going to retire. So maybe you don't want to take the distribution now because your income's already pretty high, and you're going to have a lower income, in right after retirement. And so maybe you divide by 8, 7, 6, 5, 4 after retirement. So you got to look at, we're going to, have this big income event at this point in time, and maybe we don't take it then, right? And all these things. So there are some pieces. And then depending on the rate of return that you could expect, you can run some scenarios to see, would it make sense to wait and take it all at the end, even if it was a huge tax gain, because it's still allowed to grow tax deferred versus pulling it out. Now I got to pay the tax. I got less money, and now it's growing, but it's less money, and it's growing, at a taxable rate, basically a capital gains rate, which isn't terrible, and so there is a tax calculation. This is part of tax planning that needs to be done, and it's custom. Your situation is different than your friends, and so if you're talking about what to do here, talk to a professional, about this, because this is a really big area, especially if it's a bigger IRA. So tell them about some of the different exclusions, because there's a whole bunch from what I call this normal beneficiary IRA.
Yeah, so most people will fall into this 10-year rule. Say my parents passed away, they had an IRA, they passed it to me, I'd fall into that 10-year rule. But let's say I pass away and then my sister's still around and she's within 10 years of me. She could then choose to stretch it over her or the lifetime, essentially, instead of doing the 10-year rule.
So who's allowed? So if somebody is within 10 years of my age and they inherit my IRA, they can stretch it out over their lifetime.
Yeah, so they can do regular RMD rules, or they can decide to do a 10-year rule. They get to decide which one.
They get to decide. And then, but who is it that can do that? Not just, is it anybody that's within 10 years? Or is it certain family
It's anyone
members?
within 10 years.
Okay, good.
So also there's some other exceptions to the rule. So if it was like a chronically ill or disabled person, they could also stretch it. If they're minor, it's a bit weird in a sense. They would be able to stretch it for until their age of majority, whichever, and then after that they would have 10 years to withdraw the remaining balance. So the idea is that you don't want someone forced to be taxed when they're a child, essentially. Say your minor child inherited the IRA.
So if a 16-year-old inherits an IRA, for 2 years they have to take a minimum distribution.
Yeah,
which would be very small because
Yeah.
it's based on age. So, and then at age 18 and beyond, they'd have to do the 10 years. And again, depending on the size and how much difference that would make and their other incomes, right?
Yeah, and so right now the rule is, or the interpretation of the rule is, I just have to empty the account at 10 years. But the new proposed rule is, do I have to take an RMD out if there was RMDs going on from this account already? And so I would have to take an RMD each year from 1 through 9 and then finish the remaining balance at the year end. That is what's being pushed right now. It's proposed, but if you have a current strategy, I would stick to that current strategy. You don't want to act on proposed rules instead of real rules.
Well, it's an interesting one. So I inherit from my parents an IRA that they're already taking a required minimum distribution. Then I have to keep doing that, at least that.
Yep.
I could take out more. So if I take out the required minimum distribution, but it's still at the 10th year, I have to get that emptied. It has to be emptied. So required minimum distribution at my age might not be enough to put a big dent in that. I still might end up with a massive tax hit in the 10th year, which I don't know, could be good or bad depending on your other scenarios and all. So this is where you kind of have to take a look. Now that's just a proposal too, like you said. It's not, passed yet, and so we'll see what happens there as far as that goes. I'd probably still do the calculation to see if it's better to take it out, divide by 10, 9, 8, 7, 6, or leave it for a longer period of times and just take one giant hit, right? It depends on your growth rate and some of the other things that you have going on in your life. Now there was I have some clients that have a 5-year period that they have to take it out, not 10 years. So that's another kind of exception.
Yeah, so the 5-year rule is essentially if the beneficiary is not considered individual. And so it's usually a trust. And so if the money goes into the trust, then they have to redistribute within 5 years. That's what the IRS is basically saying. This trust is not a person. We want a more accelerated rate of withdrawal.
This is so typical. I mean, I've been dealing with required minimum distributions for my entire career. We specialize in retirement. And I have done, thousands of people out to seminars and different things over the years. And the required minimum distributions have always been ridiculously complicated. Mm-hmm. They simplified them quite a bit, and now they've made them complicated again. It should just be, if you're going to do all this, why have the exceptions? Just make the spouse be able to take over. Just that's always been the case with IRAs. But then past the spouse, everybody's on the 10-year rule. Everybody has to take out, 10, 9, 8, 7, make it simpler but they haven't, of course. They give some flexibility, which is good and bad. I bet you anything, we're going to hear stories about people that don't understand this and they're going to end up with this massive gain at the end of the 10 years. They didn't even know that it existed because they managed the money themselves, or their advisor didn't tell them, or whatever the situation. It's
Yeah, I think the reason they implemented this rule was essentially in the past the strategy was give this IRA to the youngest person you have in your family and let them stretch it for the lifetime. So it was usually going to grandchildren or someone younger than that.
Yeah.
So they would just have it forever, essentially this small kind of income they stretched.
Yeah, that was great, but doesn't generate as much tax revenue.
Yep.
So, there's, and I'm okay with that, to be honest. I mean, hey, let's face it, the government has a deficit, and, they've got to find different ways to get it. They did move the age back from 70 and a half to 72, which is a good thing. But they could have still generated income and made it a cleaner tax law, but they never do, actually, which is, I don't know, that's good for our business, I guess. I mean, because people can never figure this stuff out on their own. But anyway, this is a part in your, planning for retirement, whether you're retired already or you're, not retired. Tax planning is a big one. I'm telling you, I'd say for most of my clients that what they pay in income tax is in the top 5 of their expenses in total. Not for everybody, but I'd say vast majority. And so that expense is something, if you focus on, it's amazing how much difference. And the thing I like about tax planning, my favorite part, hey, we want to make sure we don't run out of money. Well, okay, you could spend less on travel or something fun, or you could spend less on tax and still travel. That just seems no-brainer. Yet tax planning is the most misunderstood thing, just because most of the times people do tax preparation, right? And that's where you go to an accountant, enrolled agent, CPA, whoever, maybe you do your own. You're basically looking at, last year's taxes, maybe this year's taxes. We're looking at taxes all the way out for the rest of your life, age 95, age 100. We make tweaks to it to try different things. What happens if we do Roth conversions? What happens with the beneficiary IRAs? What happens if we do this? And we're trying to lower taxes. Sometimes these plans actually increase taxes now, but lower taxes dramatically over the entire life of that person, right? And that's more money for something else besides tax. Now, again, I'm not against trying to pay taxes. I think it's an important component of what we do here for supporting the country as far as that goes. But at the same time, it's sort of this, do you really want to overpay your taxes? Mm-hmm. And a lot of people, especially retirees, are overpaying their taxes because they didn't do long-term tax planning, right? And this question that comes up about requirement distributions is one of the biggest aspects of long-term tax planning in retirement. And, if I'm 40, I still want to know about this because I want to see how this is going to impact me. I want to know whether I should be adding to a Roth right now or a regular, traditional 401k or IRA, and how different that's going to make it. And there are so many things that could really alter your tax, payments throughout your retirement. Just giving you more money, give it to your family, anything, than overpay taxes. So that's why I think this is an important area.